Good morning, Banat. Good morning. Good morning. How are you? Bonjour. How are you today? Good morning. So you have 2 more units to complete Project 2. So this week will be a very intense week because today and tomorrow I'll have to finish Unit 16. All right, don't forget you have an end of unit test for Unit 15. Okay, coming up on Thursday. And then next week, I will give you the end of unit test for 16 and 17 next week so we can be finished with that and we can move on to Project 3. Thank you so much for being patient with us during this transition. And it was just simply amazing that we were able to that you were able to experience a business continuity plan, and you can actually say you've lived through a business continuity plan, and that is very, very cool. Okay, now that we had to completely alter the business of going to college and transitioning to an online platform because of this very dangerous virus. Okay, so hopefully everyone is staying safe this morning and everyone is awake and refreshed. Hopefully you had a good night last night. Now let's get busy. We're moving on to Unit 16, Part 1. There are 3 PowerPoints in this unit, Unit 16. Okay, Part 1. As usual, I hope you know where to find the resources. In the resources folder, okay, you will go to AD Business and then you will go into the files for Project 2 and then you will go into the units. We're on Unit 16, Cash Flow. Maintain financial records and monitor your cash flow. So what we'll be talking about in this section is all about money, the flow of money, how money is coming in and money is going out. Money comes in, money goes out. Money goes out, money comes in. Money comes in, money goes out. Okay, so that's what we'll be talking about, all about the financials, the records. How do you keep financial records? So when money goes in and out, we have to be able to write it down, right? You know, when you go shopping, if you're using a credit card, for example, the money is being written down, right? You bought this, you buy this, you pay for this, right? Everybody's doing financial transactions. The store owner, as you were all just store owners, right? You just did the bazaar. So you all just had to keep some financial records by knowing how much money came into your event, but you also know how much money went out by how much money you spent in your event, correct? Okay, so let's move on. So cash flow, Unit 16, Part 1, maintain financial records and monitor cash flow. Slide number 2. What is accounting? Well, accounting refers to keeping of records of financial transactions in a structured and ordered manner. In other words, the process of summarizing, recording, and analyzing business transactions in terms of accounting. Accounting statements summarize and record hundreds and thousands of financial transactions entered into by the companies in a specified period of time. Slide number 3. In no more than 50 words, write the importance of accounting. Assignment task number 1, due for today. Okay, this will be going into your folders. Okay, for task completion, you will be filling in this sheet. I will put it in everybody's folder for today. All right, so first one you have to complete for today is in no more, than 50 words, write the importance of accounting. Okay, pause the video here and then spend 10 to 15 minutes doing that. When you are finished, come back to the video and let's continue. Go ahead and stop the video now. Okay, welcome back. I hope you're back and you have written in 50 words the importance of accounting. Okay? I will be looking for those responses in your assignment sheet in your folder for today's assignments. Double system accounting and bookkeeping. Slide number 4. So, as per this system, every business transaction will involve 2 or more accounts. One account will receive a debit entry and will be entered on the left side of the T account. The other account will receive a credit entry and will be entered on the right of the T account. Okay, so let's keep going. The total of the debts must equal the total of the credits. And individual transactions may require multiple debits and credits to get the record in the books of accounts. This system helps in maintaining the accuracy of financial records. Slide number 6. What is debit and credit? Debit is the accounting entry that increases an asset or expenses account or decreases a liability or equity account. Okay? Credit is the accounting entry that increases a liability or an equity account and decreases an asset or expense account. Okay? So we're talking about money coming in and money going out. Money coming in and money going out. So debit, okay, increases an asset. So that's money coming in. Debit increases an asset. We're on slide number 6. Debit increases an account, okay, asset or expense account, or decreases a liability or equity account. So when you have debit, when you have cash, you can either increase your asset or expense account, or you can decrease your liability, things that you owe, things that you made a payment on, things that you owe. So you could also use a debit to pay down on things. So cash, for example, is a debit, is cash. All right. So you have debit of 1,000. Okay. You have 1,000 in machinery. You bought machinery. Okay. And you have cash of 10,000 will be the credit. So the debit will be 10,000 on the machinery, and the cash will be 10,000. It's the same, because where there's a debit, there has to be a credit. The money is coming in and the money is going out. So we're showing the transaction. That's all we're doing. We're showing the transaction. In the account, when the account is a credit, okay, this is money going out. Okay, money going out. In an accounting entry that increases the liability or equity account and decreases the asset or expense account. So when you have a credit, you're spending. Okay, you are spending money. So that means that your liabilities, your debt is going up. Your liability is going up and decreases your assets or your expense account. So you're not having liquidity. You're not having extra money. If you're spending money, you are not having extra money. You have 1,000 reals right now. Write down 1,000 on a piece of paper. You have 1,000 reals. Write it down on a piece of paper right now. You have 1,000 reals. So you wrote down 1,000 on a piece of paper. Excellent. 1,000 SAR. Please write this down. Okay, you have 1,000 reals. And then what happened at this point? Well, let's show that it's a debit, meaning that you did something good with this. So there's 2 things you could have done with this. You could have drawn an arrow, okay, with the same 1,000, draw an arrow on the left. And on the left, and I don't want you to do left and right for this example. I just on one side, on the next side, okay? So on the left, we put, we paid a bill. Okay? And then the other side, you're going to put the word cash. So this is how a debit, this is for debit, D-E-B-I-T, not debt, debit. Okay? Debt is D-E-B-T, And debit is DEBIT. So on your debit, you will have 1,000 reals, and then you pay the bill. Okay, so the bill is now going down, it's decreasing. Okay, you're paying it, so that means that you'll have less expenses, less liability. And then you have the other side, you have cash. Okay, you have cash, 1,000 reals, for example. Okay, these are all positive things, positive debit. Now, let's write down the word credit, CREDIT, credit. Write the same 1,000 reals, 1,000 SAR. On the right side, you're going to buy something. And then on the right side, so on the left side, you're buying something, so you're spending. Okay? So now, what's happening with the credit? Well, right now, your liability is increasing because you're shopping. Okay? Your liability is increasing, so you are shopping. So this means that the money that you had in your account is being debited. So the arrow is going down. The money is being spent. So you're not having the $1,000 in your account anymore. You're shopping. Okay? You're shopping. I know this is very complicated and a little bit uneasy to understand, but please try to follow me, okay? Try to follow as best as you can. All right. Let's keep going. Let's see if it becomes a little bit more clear. Okay, slide number 7. Impact of debt and credit on the 3 balance sheets. So let's talk about 3 balance sheets, okay? So please write this down. Balance sheet. BALANCE sheet. SHEET. Balance sheet accounts. So there are 3 types of balance sheets accounts. We're talking about the asset accounts, okay? Your asset accounts. This is a debit increase and balance, and a credit decrease on the balance. Liability accounts, a decrease, a debit decrease. A debit decreases the balance and the credit increases the balance. Okay, equity accounts, a debit decreases the balance and a credit increases the balance. So take a minute here if you don't know what anything that I'm saying about a balance sheet. I want you to stop the video and go and look it up, okay? Don't think that this video, you have to keep the same pace, all right? You must stop the video so that you can pace yourself so that you understand the material, okay? So we're talking about debits and credits. There are 3 types of balance sheets: an asset account, liabilities, and then we have equities. Please go ahead and research asset, liability, and equity accounts. I'll also go ahead and add these words to your task for today so that I am fully aware that you know what these accounts all mean. So go ahead and actually stop the video, and I want you to take 10 minutes to look this up. Look up what it means, and you may not find very clear ideas, but you may just write down a few ideas that you see on the internet. So hopefully this will make it go a little bit easier and you could understand it a little bit more. So asset accounts, liability accounts, and equity accounts. Go ahead and stop the video now and go and do some independent research. Okay, welcome back. I hope you've able to look up what it means to have those 3 types of accounts. All right, so an asset account, as we said before, is an account that is positive. It's an account where if you put more money in it, more money will be there. Okay? If it's an asset account, maybe if a house is your asset, you're paying more money on the house is going up in equity. Okay, this is a little complicated. I get it. But just have the understanding that maybe money affects these accounts one way or the other. Whether money comes into the account or money goes out of the account is affected one way or another. And the 2 ways the account is what word am I looking for? The account is reference to, or the two ways that the account, that we understand what's happening in the account, is that it's a debit or a credit that's happening in the account. Money comes in, debit. Money goes out, credit. Money comes in, debit. Money goes out, credit. Money goes in, debit. Money goes out, credit. Okay? I don't expect you to be an expert in this, but I just want you to know money can come in or money can go out. And it affects how your bank behaves. Okay, next. Balancing debit and credit. The difference between the total of debit side and the total credit side of an account balance. If debit exceeds credit, the account has a credit balance. If the credit exceeds debit, the account has a debit balance. Trial balance is prepared to check whether the amount of the debit balances is equal to the amount of the credit balances. Okay, so now we're balancing the debit and the credit. All right, so the difference between the total debit side and the credit side is the account balance. If the debit is more than the credit, then if the debit is more than the credit, right? Then the account has a credit balance. Okay, and if the credit exceeds the debit, then the account has a debit balance. Okay. Slide number 9. Accuracy of entries. The entries must be correctly entered in the accounts and needs to be accurate. Okay. The purpose of the accounting is to keep a record of business transactions. Any wrong entry would defeat the very purpose of accounting. In order for financial statements to reflect true and fair view of the financial position of a company, entries must be correctly recorded in the books of accounts, and effects be made to ensure precision of accounts entered. Okay, so you want to make sure that the account is accurate, that the entry, when you are writing down what's going in your account and what's coming out of your account, you all just spent some money. Okay, you all just did an event. Money was coming in, money was going out, in and out. And so we need to track it. It needs to be accurate. It needs to be right. That's what the word accurate means. It needs to be correct. You need to know exactly how much money went in and exactly how much money went out. Okay, that's all we're talking about right now. Okay, don't get caught up in these fancy words in this PowerPoint. Okay, slide number 10. Accounting systems. We're on part 16, unit 16, part 1. Accounting systems. Whole accounting is based on two systems. We have a cash system of accounting. Under this system, a company or a business records customer receipts in the period of actual receipt and expenses in the period which they are actually paid. Accrual accounting system. Under this accounting system, the revenues and expenses are recorded when they are incurred and not when they are actually received or paid, respectively. The time period of exchange of cash is immaterial. All right? So we have two ways of how accounting is done. You can do accounting by cash. Okay, under this system, the business records all the customer receipts. Okay, and their expenses for that period of time based on if it is actually paid. Okay, so that's the cash accounting system. They're only counting things that are paid. Then you have the accrual accounting system. Most companies really use this system. Okay, this is a system where revenues and expenses, so revenue, please write this new vocabulary word down. Revenue, REVENUE, and expenses. Revenue and expenses. Revenue is money you've made. Okay, please look up the word revenue and expenses. Stop the video here. I'm going to actually add these two words to your list for today of assignments that you should be completing for today. All right, revenues and expenses, because you need to know what is revenues and what is expenses in order to continue with this lesson. So take 5 minutes, stop the video, go ahead and complete the assignment for revenues and expenses. Go ahead and look it up, see what it means. All right, and make sure you understand it. Write it in your own words. What do you think revenues and expenses mean? 5 minutes. I'll meet you back in 5 minutes. Pause the video, and I will come and meet you back here in 5 minutes. Okay, so we're talking about revenues and expenses are recorded when they are incurred and not when they are actually received or paid respectively. So the accrual accounting system counts everything. It counts money that you owe on credit. It counts money that you've paid in cash. It counts everything. And usually the world operates a lot on this system. Nobody really uses the system, the cash system of accounting. Okay, that's only when things are paid. We're using the accrual. We're depending on when bills are paid. All right, so every month you have a cell phone bill. The company expects that money every month, whether you want to think that they do or they don't. They expect that you are going to pay this bill. That's why they send you a bill. They're hoping that you pay this bill for your cell phone, okay, for the month. All right, that's why we're working on this accrual accounting system. Okay, let's go on to slide number 11. What is accounting cycle? What is accounting cycle? It is the process which starts from recording of business transactions, which eventually progresses to a preparation of financial statements. So the accounting cycle is recording all of the business transactions, which will lead to the preparation of financial statements. Now we're going into financial statements, okay? Slide number 12. What is the accounting cycle? Following the steps involved in the accounting cycle. Write these steps down. Here's the accounting cycle. If you were going to draw a little circle, draw a circle on your piece of paper, and I want you to draw in and write in all of the accounting cycle. Counting cycle. All right. Draw it into a visual map. I want you to draw it into a visual map, the accounting cycle. Put it in a chart. Okay, put it in a chart in Microsoft Word. I'm actually going to include it in this lesson. So you're going to put the accounting cycle, okay, into a visual chart or graph. Okay, so number 7 on your sheet is asking you to put the accounting cycle in a visual chart or graph. Okay, so you will put this in a visual chart or graph, the accounting cycle. Slide number 12. What is the accounting cycle? Well, following the steps involved in the accounting cycle, you will record journal entries. You will post entries in a ledger of accounts. You will prepare unadjusted trial balance. You will adjust the journal entries. You will prepare adjusted trial balance. You will prepare financial statements such as a profit and loss statement, balance sheet, statement of retained earnings, cash flow statements, record closing entries, prepare post-closing trial balance, and record reversing entries. Okay, so the accounting cycle, as you put this visually, you may not know what any of these terms mean, and that's okay. What I want you to understand is that something is happening with money for a business, that the way how it's recorded goes into all of these things. It's going into where the money is at what time and how it's looking in all these different papers. Okay, so in a company, they have many papers that deal with accounting, many papers. And these papers are called recording journal entries, posting journal ledger accounts, trial balance, journal entries, adjusting journal bench, we have the profit loss statement, the balance sheet, we have return retained earnings, cash flow sheets, okay? We have the closing entries, we have reversing entries. So many things are happening at different times with the money. The money isn't just happening like that, okay? The money goes into a business and there's many things happening. So you have drawn this visually and you should see it. Okay, let's go to slide number 13. Journal entries. What is a journal entry? Well, I'm going to show you right now what a journal entry is. Recording journal entries. A journal entry is the book of original entry in which the business transactions are firstly recorded. So when a business is spending money, okay, this is the first place in the journal entry. Not a journal that you're writing like, your calendar in. This is a journal for money in a business, okay? So the journal entry says what's happening with the money, when the money comes in and when the money goes out, and what that means for the account. If the money goes in, the money also has to come out, okay? The money goes out, there's money coming in to replace that money. Okay, so money is going in and out, in and out, in and out. Okay, so slide 14. Books of prime entry. All transactions are recorded in one of these books before they are entered in the ledger. The books of prime entry are cash book, petty cash book, sales journal, purchase journal, sales returns journal, purchase returns journals, and then your general journal. Okay? These are your books of entry. I want you to write these things down. Just write down what are all the transactions are recorded in one book. Okay? What are the books of prime entry? That is question number 8. Write down all the books of prime entry. Okay, so you will write this down on your sheet. That's number 8, okay, for today, so that I know that you understand that there are all these books. And when we use the word books, we just mean papers, okay? It's all these different papers that have this information: the cash book, the petty cash book, sales journal book, purchase journal book, sales return journal, purchase returns journal, and the general journal. Okay, so let's go on to slide number 15. Let's go into what each one of these books are. So your sales journal is the only sales of goods on purchase of recorded in your sales journals. Okay, so only sales of goods on credit are recorded in your sales journals. Cash sales are recorded in the cash book. Source documents used in sales invoice. Okay, so if you have sales of goods on credit, meaning that somebody owes you money, like how I made you prepare an invoice for somebody, that transaction, the $10 or 10 reals will go in this book, the sales journal book, because it's on credit. It's not paid for yet, right? So when there is transactions that's conducted in cash, for example, cash, okay, sales cash on record, it will go into your cash book. So if you're spending cash or your customer is spending cash, it will go into the cash book. Okay, and this is how we get a source documented used in is sales invoice. Okay, so sales journal is again recording money that's coming into the business either by credit or the money is coming in by cash. Okay, sales return journal. So sales return journal, in other words, book. It is used to record all returns inwards. It is written up from the copies of the credit notes sent to customers. All right, so it is used to record all returns inwards. It is written up from the copies of the credit notes sent to the customer. So when the customer returns something, sales return journal, the customer goes to the store, she returns an item. Most likely, you will put it in this book. Okay, you write down that she's returning this dress, and this is how much she's returning to the store. All right? Fabulous. Let's keep going. Slide number 17, purchase journal. So your purchase journal, this journal is used to record all of the purchases made on credit. Purchases of fixed assets are recorded in your general journal. Cash purchases are recorded in the cash book, source document used in invoice received from the supplier. So purchase journals is the journal is used to record all of the purchases made on credit. All right, purchases of fixed assets are recorded in the general journal. I know this thing is a little complicated, but don't worry. All right. Slide number 18, purchase return journal or returns outward books. It is used to record all purchases returned. Okay, it is written up from the sales notes received from the supplier. So purchases return journal is just another way when the customer purchased something and they return it, it's outwards. Okay, it records all the purchases returned in the written form from the credit notes received from the supplier. All right, if you don't understand anything that I said in this, go back and listen to it again. Research on the internet things that you do not understand so that you can move forward to part 2, which we're moving on to in the next video.